Fox Market Alert. Well, the ink has now apparently been put to paper. Warner Bros. Discovery executives announcing at a town hall this morning, according to reports, that the deal has now been signed. Both the winner and the loser of this bidding war for Warner Bros. Discovery are heading skyward. Paramount Skydance rocketing up 19.6%. That's not even the high of the session, by the way. Netflix gaining 13%, topping the NASDAQ. This after Paramount finally emerged as the victor in the merger war. Yesterday, after the bell, WBD officially deemed CEO David Ellison's new $31 a share bid superior to Netflix's $27.75 offer. Netflix was then granted 4 business days to match or counter, but just an hour and 10 minutes later, Netflix surprised just about everybody by announcing, we're done. The deal no longer financially attractive. They summarily walked away, leaving Warner Bros. Discovery CEO David Zaslav with, yes, a better bid than when the process began back in November, but with no more money to squeeze from this process. WBD shares down 2% at the moment to $28.19. But what are the stock moves really speak to about what happens next? Media analyst Rich Greenfield of LightShed Partners, who's been calling balls and strikes on the deal for months now, is with us now. Rich, your gut reaction first to how this came down last night.
Look, it's always surprising. I think, there was so much, Netflix put so much effort into this. Seeing them have the discipline to just walk away and not get caught in an ever-increasing price battle was fascinating. I certainly didn't see it. Ted Sarandos and Greg Peters had spent so much time, advocating and trying to make the case for this deal. And I think the ability to sort of just cut bait and move forward and literally not even flinch is something you don't see. I mean, I think there's, so often emotions take over and you get caught in this. And I think not overpaying. I mean, look, we were on your show not too long ago talking about, Paramount. Do they really want to be 7 times levered? Do they really want to be, is this really the right transaction? Paramount wants this. They believe that to accelerate their strategy, they need Warner Brothers, and they were willing to pay any price to win. They won. Now they've got to prove, now they've got to execute, right? Like we are still in the first 6 months since they bought Paramount, meaning Skydance. Now we're in buying Warner Brothers. There's a tremendous amount of execution risk, and all eyes are going to be on David Ellison. I've never seen a company go from, single-digit billions of value to now being something that's going to be worth $100 billion, like in the matter of 12 months.
Okay, so notwithstanding the current, at this second, 19.5% jump in Paramount Skydance shares and the big jump for Netflix, 24 hours later, who looks smarter, Paramount for winning at $31 a share or Netflix for walking away with $2.8 billion, Richard, thanks to Paramount covering the breakup fee? By the way, hitting the tape right now, Bloomberg reports that $2.8 billion breakup fee owed to Netflix for dropping their bid has been paid already, that it's been paid. So who looks smartest?
I mean, look, you just said 24 hours, Liz, and I don't think this is a 24 hours. Like, it's going to take time. This is what's going to happen. Investors are going to look at this or have been thinking about, was Warner Brothers a need to have or a like to have from a Netflix standpoint?
Well, they said it was a like to have.
Correct. Mm-hmm. We're going to find out, right? How do you find out? We're going to see Netflix's results over the course of the next 12 to 18 months. Are they able to accelerate engagement without buying this? Are they able to continue to grow revenues double digits? Like, if management executes, they're going to prove to people this would have been great at the right price, but they didn't need it. But that takes time. You don't learn that in 24 hours. That's going to be the bet. I believe they didn't need it, but I think for investors to believe it, and I think there's relief this morning or today, just simply that they're not chasing this going too far and putting up too much leverage. I think that's part of the relief from a Netflix standpoint. From a Paramount standpoint, I think this is, now they're a real company. I think people sort of looked at Paramount and said, I don't know if this company is big enough to survive. I think they look at the combination and they go, the leverage probably is too high. There's probably going to be a large equity offering after this closes to delever, but at least they're big enough to survive now.
Well, listen, you talk about the debt that is so onerous. At least it turns out to be what will be the largest leveraged buyout in history. And we can put up the numbers here. It's pretty stunning. According to the earnings reports, most recent, Warner Brothers Discovery had about $30 billion in debt. Paramount nearly $14 billion. Paramount also has to take on $57.7 billion in debt. They're going to borrow from Bank of America, Citigroup, Apollo, because those are the banks and entities providing that debt commitment. You've got the aortas just clogged with financial plaque. Once they take this thing over, how long before it clears out?
Well, Liz, when they bought Paramount, the excitement that we had over that transaction was that for the first time, I followed Viacom, the predecessor to Paramount, back to 1995.
I remember, yeah.
It's been a long time. It's been a long time that this company has been sort of hamstrung, sort of a hand tied behind its back, not able to invest. If you think about sort of the Redstone era, too levered, not able to really invest for the future, always short-term thinking. And that really hampered the company, and it showed in the stock price. The excitement of Skydance buying it was that you had actually delevered the balance sheet. Now you're dramatically re-leveraging the balance sheet. I think the question is going to be, how do they deleverage quickly? And is that an equity offering? Do they sell some assets? Like, those are the types of questions I think investors are really going to start to ask over the course of the next year, because the reality is being 7+ times levered at closing is not a great place to be in the media world, especially just looking at sort of the trajectory of linear TV.
Cool. And as we go, David Zaslav, the CEO of Warner Brothers, listen, he gets $31 a share when the stock was trading much lower just a year ago. But if you look back to 2021 and March, you see when he effectuated the Discovery Warner Brothers merger, that was a much higher stock. I mean, it was like $78 or something. It's shocking, isn't it, that nobody ever was able to really kind of reach that again really quickly.
Look, Liz, the reality is the legacy media sector overall is tough. I mean, your parent company has taken a very different tact, and it's actually worked out, from a fundamental standpoint. I think what Lachlan Murdoch and Rupert Murdoch have been able to achieve by narrowing the focus of the company and selling off a lot of assets to Disney.
Yeah, pretty brilliant.
That's been the really smart approach. Yeah. The reality is trying to operate a company with a lot of linear TV, especially a lot of linear cable assets. Everyone is struggling. I mean, Disney stock is down for the past decade.
Yeah.
Look at Comcast, down for the last decade. This is a very tough sector. The only reasons investors have really wanted to invest in media is when there's M&A. And that's what certainly created the opportunity in Warner over the course of the last 12 months was the value creation from M&A. From a pure operating standpoint, outside of Fox, it's been really hard.
Well, Rich, you have to find something new to talk about, so we'll be watching it. Rich Greenfield, thanks for joining us. We appreciate it.